Hey everybody, thanks for coming to my channel, A Lender's Point of View. Today we're going to be talking about what are mortgage points and how they're used by a lender when they go out and look for a type of loan for you for your new house. It's really important that you actually watch this video because I've watched quite a few of the different videos from other lenders out there, and what they do is they tell you these things, but they don't actually show you what it actually means to you as a borrower. So that's what we're going to talk about. First of all, as far as points are, so what happens is that when you go out there and you look for a mortgage loan, a lender generally is going to offer you, well, more than one rate. In fact, when I come to the different companies that I look at, sometimes we might have 10 to 15 different rates for one particular loan. And that means basically is that the lender is going to be giving you, they're going to provide choices for that rate for you. And so it's going to be up to you to choose what's maybe the best rate for you. But sometimes what happens is the lender is going to like suggest a lower rate for you based off one, as far as the rate, there may be like a sweet spot where they're offering a discounted rate, and we'll go over that real quick. Or maybe you need a lower rate just because you have to qualify for a more higher payment, and so they need to find some way to lower that payment so you can qualify for that house. Or maybe the seller is going to give you a whole bunch of credits towards your closing costs. So you got to use those credits because it's either use it or lose it. So you can use that part as far as buying down your rate in order to do that. So you have to kind of think of it. There's a basically a relationship, basically like a seesaw, as you see right here. Right here, you got the rate on this side and the fees on this side. So if you want a lower rate, you're going to pay higher in fees. So just know that when you go out there. Now, over here, what we've done is I've created a chart here for you to see. And you can get the differences in rates based off of any type of loan, conventional, VA, USDA, FHA, and jumbo loans. So think about that when you go out there. It doesn't make any difference what type of loans out there, but it does, they all have this. Now, the type of lender that you have may only provide certain options for you. When I worked for one particular bank a long time ago, they had one option for you. So they said, what is your rate today? They said, here's my rate and here's the fee. And then another company had three different types of rate. They said, well, you have this one, or this one. And so what they're doing is they're just choosing to work within that framework. But realistically out there, lenders have whole bunches of rates that are available for you if you're willing to pay the fees. And so let's kind of look at this scenario here. So over here, what I have is I have a scenario go from 7% all the way down to 6.375. And what you can see here is 7% is there's no buy down on that rate. So that's what they call the par rate. Okay, so it's a rate that you're going to get without paying any additional fees to get that rate. Okay, so it's zero fees. And so as you can see in this case, on a $200,000 loan, the payment's $1,328. And over the course of the term of the loan, you can see way over here that you'll be paying $479,000 for total payment on that loan over the course of 30 years. So the next one is 6.875, and here you're paying 0.625 or $1,250 towards the closing costs. So you're going to pay an extra $1,250. It's going to save you roughly $14 a month, and it's going to take 86 months for it to pay for itself. So it's going to take 7 years before you're going to break even. That's really not a great deal for you because realistically, most people, they only keep their existing loans for 5 years, and most people also think about selling their house after 7. But it does save you about $6,000, $473,000 over the life of the loan. The next one, 6.75%, it's a 1/4% better than the 7%, and it costs you $1,500. So it only costs you $250 more there, but now it's saving you roughly, well, quite a bit, about $30 a month, and it only takes 44 months for it to pay for itself. So that's 3 years and about 8 months. So realistically, that one actually pays for itself. So that one might be a good option if you want to do it. and it's going to drop your overall down to 466,000. So it's going to save you roughly $13,000 by paying this $1,500 up front. Not a bad deal. And 6.25, you can see it costs 1.25, and here's a 1283 of 461. But then the next one at 6.5, it only costs you an extra quarter. And then you can see this one, 1269. So now it's going to be roughly about $60 a month, and once again, $44 in total break-even point, and it's going to save you roughly $24,000 over the life alone. So it's about $700 a year. So that's a pretty good deal out there if you think of it, if it's going to pay for itself. And then, of course, then you can see at 6.375, it goes all the way up to two and a half. So it costs you $5,000, and now all of a sudden it's going to take you 60 months to break even. So as you can see here, the numbers don't, even though the numbers drop by eighths here, they can change incrementally here. And they change every day until you lock the loan. So once you lock the loan, you're locked into those rates for that day that you actually locked it in. So all types of products, that whole sheet of different rates are going to be available for you. So closing, I want to kind of go over some key points for you to look at. The first one is how long are you going to live in that house? If you're only going to live in there for 1 or 2 years, don't buy your rate down unless you have to qualify. It's not worth it. Okay? Will you be refinancing? Well, that's a question we all have right now. Some people, believe it or not, are buying their rates down all the way to 4% or 5% on a government type of loan because it's a lot cheaper to buy the rates down there. So think of it that way. If you might refinance in a couple of years when rates go down, if they go down, then it's going to be more beneficial maybe to wait and do it then. The next thing, do you need it to qualify? Well, if you do need it to qualify, and some clients do, they want to get that specific house, and it's going to cost them, this month in payments, so they have to buy their rate down to get that payment down. Well, then it could be worth it. And then finally, other things, opportunity costs. What else would you buy? When you go and you pay for this to go down, well, what's going to happen if you're using cash out of your bank? What happens when you want to put stuff, maybe some small improvements, paint the inside of your house, put new carpet or things like that? If you have to put those on a credit card, well, now you're going backwards. So don't do it that way. Keep the money and then go ahead and just use that cash to buy your other improvements to your house. Finally, look at the lenders that offer all these type of options and maybe more options, because those type of lenders are going to give you the best options that are available. I hope this helps out. Thanks for coming to my channel today. And if you do have questions, please drop me a line, and please hit that subscribe button and like that button as well too. Thanks again for coming to my channel, and we'll see you again on my next video. Bye for now.